It's almost the end of the first quarter of 2022 and there seems to be much doom and gloom in the real estate market. Hey, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Welcome to the channel. I've been seeing a lot of negative news in regards to the real estate market lately and I'm kind of starting to get worried. Let's look at what the guys at CoreLogic has to say about potential price declines first and then go into 5 things that are happening now and will continue to happen in the future that could eventually lead us to a price decline. First off, CoreLogic talks about the relationship between home price growth and the share of metropolitan areas with price declines. Now, to be honest with you, I don't totally get this part and don't know why it's important. But since they mentioned it in their article, I figured I include it in this video. Basically, they're saying that even in times of rising home prices nationally, there are certain metro areas that are experiencing price declines. I think this is a given. Not all markets are the same. So it shouldn't come as a surprise that certain areas are not following the national trend. The article continues on and it touches on the CoreLogic market conditions indicator. The bottom line here is that they stated that, quote, the CoreLogic market conditions indicator, which provides a benchmark that indicates if a metro area's home prices are overly high compared to local household income. If they are, the market is considered overvalued. As the map illustrates, many of the markets in the mountain, west, and southwest, where home prices grew by as much as 20 to 30% year over year in December 2021, are now overvalued. Unquote. So they said that those areas are overvalued, but they actually also said this. Nevertheless, the risk of price declines remains low. But they did make mention of certain areas that could decline. In fact, as high as 70% chance of decline. They mentioned Prescott, Arizona, Merced, California, Lake Havasu City, Arizona, Worcester, Massachusetts, and Kalamazoo, Michigan. And this is why they say these places have a high probability of price declines. Quote, according to the December CoreLogic market risk indicator, only 12 metro areas had over a 50% probability of a price decline in 12 months. 1/3 of the metro areas had a less than 10% probability of a price decline. The risk for a price decline, however, remains higher in the Northeast, the West, and the Southwest, and is generally driven by a higher rate of unemployment, lower income growth, and or lower rate of population growth. On the other hand, the areas that are considered overvalued but remain with a low risk of price decline are supported by low unemployment rate and stronger income growth, largely brought on by in-migration of populations with higher incomes and solid housing starts. Unquote. What they are basically saying here is that, look, we know a majority of the places are overvalued or expensive, but if the local or regional economy is strong and income is growing, that market has a less likelihood of declining. And that is why here in the Bay Area, home prices seems to be escalating year in and year out. There are a lot of high-paying tech jobs in the region that supports these prices. Places like Merced, which is about 2 hours or more from the Bay Area, where income is not increasing because there are no major big corporations over there, they are more prone to a price decline. Now let's move on to the 5 things that are happening now and could continue to happen in the future and eventually could cause this real estate market to implode. The first one is mortgage rates. You most likely have heard that mortgage rates have been going up. No doubt this will continue on throughout the year. Right now, the prediction out there is that we will see mortgage rates around 4.5% by the end of the year. Last year, when mortgage rates were being forecasted, none of the early forecasts talked about rates going as high as 4.5%. Quite frankly, I don't think they are done revising these estimates further upward. We will probably see mortgage rates go up and down throughout the year, but nowhere near the low rates that we've seen in the past. Right now, it seems like most experts are in agreement 4.5% could be the range for the year. This mortgage rate increase was expected. Last year, everybody was pretty much in agreement that rates were not going to stay as low as they were, particularly since the feds were signaling that they were raising the federal funds rate. What wasn't expected was just how fast the interest rates went up. I mean, we went from below 3% to almost over 4%, and it seemed like it happened overnight. That was a total shock to a lot of people. The unexpected result of this was that buyers went on full buying mode at the beginning of the year. A lot of buyers wanted to make sure that they still can get those low mortgage rates. Another side effect of the mortgage rate hike was that prices got squeezed up some more because there were more buyers than normal, trying to take advantage of the lower rates. I personally think here in the Bay Area, we can weather interest rates all the way up to 5.5% to 6%. And by the way, this 4% mortgage rate is not unknown territory to the market. It was only back in 2018 when we had rates in the 4% range. So it's not like we've never seen these rates before. The bottom line for this is that there will be times when mortgage rates go down a bit, but nowhere near the low 3% that we got used to. And mortgage rates will continue to climb even higher. Another thing to look forward to is less competition. As we continue on this path of rising mortgage rates and rising home prices, it's only logical that there will be home buyers that gets priced out of the market. However, this less competition doesn't mean home prices will go down. The biggest challenge that we still have is not enough inventory of houses and increasing demand. Plus, I would argue that buyers that gets priced out because they can't afford anymore, they weren't really a factor to begin with. And here's why. Let me give you a sample scenario. If you have 10 buyers for a house, only one gets it, right? Now, you have 9 other buyers that are still looking for a house. Say 3 of those buyers no longer can afford in the current market. You still have 6 buyers out there that's still competing for limited inventory, not even counting new buyers that are coming into the market. You see what I'm saying here? Those 3 buyers that drop out weren't really going to be able to get a house in whatever market. And if you're a buyer, this is absolutely important to know. If you are competing with other offers, you need to find out where your offer landed out of the competition. If your offer consistently lands at the bottom, you're probably not going to be able to get a house. And it seems like this is happening already here in California. The latest report from the California Association of Realtors could be a precursor to this. Home sales are down both month over month and year over year, but prices still went up. So less home buyers, but still home prices are going up because there's still not a lot of inventory out there. So that's what I mean by prices not getting affected at all. It will be a little easier to compete, but definitely still bidding competition. There is a little bit of good news though, and that is home prices can't continue with this rapid price appreciation. Forecast estimates right now are all over the place. You have Zillow and Goldman Sachs forecasting home prices will go up again this year in the high teens. Goldman says around 16% and Zillow around 17%. On the conservative side, you have Fannie Mae saying around 11% and the rest of the other experts are saying just under 6% appreciation. All markets are completely different and we will continue to see this gap in home price appreciation this year in various markets across the US. It could be more pronounced in some areas, especially if you look at the CoreLogic data that I mentioned earlier. In fact, in their data, they even suggest major price declines in some markets. Areas in the country that are still relatively affordable could still experience double-digit gains. I think what could happen is that we continue to see people moving into these more affordable areas, and this is what will continue to push those markets higher. Higher price areas could see slower growth depending on regional economic factors. Here in the Bay Area, like I mentioned earlier, I'm sorry to say this, but I see us continued double-digit price increases this year. California as a whole, probably in the high single digit. Okay, repeat after me. It's not going down. Prices are not going down. Appreciation will slow down. That is what the majority is forecasting. But there's no consensus so far as to how much of a slowdown it will be. And to be brutally honest with you, the numbers that I mentioned are still high. This is where most home buyers get confused. They think that prices will go down. And so what happens is that they wait it out, only to find out that prices have gone up some more and interest rate has also gone up, thereby making everything more expensive. While most of the competition will be centered around lower price homes, more expensive homes might be easier to get if you're in that market. By this, I mean homes that are 30% above what the median price home is for a certain market. Nationally, this is what they are saying. This is according to the National Association of Realtors. Quote, homes priced at $500,000 and below are disappearing fast, while supply at higher prices has risen. There are more listings at the upper end home priced above $500,000 compared to a year ago, unquote. There is a lot of truth to this. Take a look at my local market here in Castro Valley. The median home price last month was just under $1.4 million. As you can see in this table, there are less homes getting sold above that price range. In this case, it's above 1.7 million or around 25% over the median. There's only a total of 3 sales happening. But if you look back last year, 2021, there was a total of 46 sales above that number. So higher price homes will most likely see a slowdown this coming year. Here's another thing that you will most likely see in the headlines. Foreclosures are increasing. This has been the rallying cry of bargain hunters since we started the pandemic. Once the mortgage forbearance programs comes to an end, there will be an increase in foreclosures. And guess what? There are mortgage forbearance programs that has ended. Along with this, there are actually homeowners that could still be out of work. And if that is the case, it will probably be hard for them to continue making their mortgage payments or reinstate their account. Actually, foreclosures are already on the rise. In fact, here's the latest from Realtor.com. Quote, foreclosure filings were up 11% from January and foreclosure starts grew 40% month over month. There were 25,833 U.S. properties with foreclosure filings in February, a 129% increase from a year ago. Now, if you were just to look at those numbers, 40%, 129%, it would seem that all hell is about to break loose again. 2008 all over again. But it's not. In fact, all these numbers, while increasing and increasing a lot, is still way below pre-pandemic levels. According to one expert, in today's market, we probably have less than 0.5% of loans in foreclosure, with roughly 220,000 loans in foreclosure. In a normal market, that number could be closer to 550,000. One of the biggest reasons that there won't be massive wave of foreclosure is because prices have gone up significantly in the last 3 years. So a lot of the homeowners are sitting on a ton of equity, even if they have been on forbearance for the last 2 years. And when there is equity, no one is walking away from their homes. So while you might see foreclosure filings going up, chances are a majority of these homeowners in foreclosures could still end up selling the normal way and walk away with money in their pockets. That's the 5 things that is happening now and will continue to happen in the future. When you look at all these and you look at all the data that we have available to us, it's quite hard to come to the conclusion that we will see a housing market collapse. However, there's one big glaring thing that can really screw everything up. It's not inflation. Home prices actually do well during times of inflation. It's the war in Ukraine, plus all these other factors combined. I've said it before in this channel, the thing that could derail this housing market will be an outside force not related to the housing market. Look, nothing has changed. Inventory is still historically low. Demand is still way up, and interest rates are still relatively low. Prices are high, but people are still buying and can afford to buy. The economy is still good. But if you throw in the war and it escalates to total US involvement, guess what happens? It becomes really scary, and when people are scared, it doesn't matter what the numbers will say. People will become more cautious. They start really looking at every little thing that could go wrong. Gas prices going berserk, inflation sky high. Next thing you know, consumer spending is down and it's bleeding all over the economy. And when that happens, our economy contracts and layoffs starts happening. That's when we really start to see some home price declines. That scenario is not far off. Hey, look, I'm not being overly negative here, but these things all together could be the start of a decline. And as we've seen in the past, once everyone wants to head to the exit at the same time, it could lead to a rapid decline. Hopefully not. Real people are involved. Real lives are at stake. But it is what it is. Hey, thanks for watching. Please like, share, and subscribe. It really helps our channel. Have a great day.